Hello, everyone. Happy Tuesday. Hope everybody had a good Easter weekend. Probably a long weekend if you had off on Friday or Monday with your job. If you are self employed, there are no days off. I'm going to give it a few minutes for everybody to join. This will be the normal how we go through the different types of loans. So we're doing the 10% down vacation home loan today versus the 15% down investment only conventional loan today, how they are different, what you can do with each of them, and the frequently asked questions around them, so you all exactly know the difference and know which one will best suit your needs if you are looking for conventional loans. So I'm going to add while I wait for everybody to join. If you are a first-time investor or you only have like one short-term rental, put in the comments that you're either a first-time investor or only have one short-term rental if you're looking to expand your portfolio. Things like this, because this is going to really help you gauge whether or not which loan type will be for you, and will be able to help you know what to qualify for next, what loan type to qualify for next. All right. The 10% down vacation home loan versus the 15% down investment loan. So busting myths and what you can really do with each of these loan types, okay? The 10% down vacation home loan. George says, currently have one short-term rental as an investment loan property. Cool. Primary intent is to vacation there first. So if you are just getting started in this, whether you have like one short-term rental, you're thinking about getting another in maybe a different market, trying to expand your portfolio slowly, still, getting your feet wet essentially in the industry. You would want to vacation there first and then rent it out when you're not occupying it. One, to get to know the area better that you are hosting in, to be a better host or co-host, what have you. And that way you have things you can recommend to them, like restaurants, fun activities to do, hiking, trails, things like that. It is not a second primary residence loan, okay? I have a lot of people in these groups, if you see somebody's like, I put down 5% on a second home. If you get into the nitty gritty of it, they don't realize there's a difference between a true vacation home loan and then house hacking, which is living in a primary residence for a year, moving out, renting that out, and then buying another primary residence. So they're saying, yeah, I got a second home loan, but they're really meaning a second primary residence loan. This is a vacation home loan. It is known as a second home loan, but so you all won't get confused, we're just going to continue to say vacation home loan. It's totally different than a primary residence loan. I am going to go through frequently asked questions, but if you want to put your questions in the chat, I will answer those at the end. If you don't want to lose your train of thought and forget your question, go ahead and put those in the comments as they go, and I will get to those at the end. It requires a minimum of 10% down. So this is that true 10% down vacation home loan. You are allowed to rent it out when you are not occupying it, according to Fannie Mae and Freddie Mac. They do not have any rules that say you cannot rent this out whatsoever. We'll reiterate this in the next slide, that if your bank says you're not supposed to rent out your second home or vacation home loan at all, that's mortgage fraud. They throw that out. That is because that is their rule. That's how they've been trained. Many banks that hire their loan originators, they do not actually have to be licensed as an actual loan officer with the NMLS and the state. They are just going off the rules that the bank allows and don't really know the actual rules of Fannie Mae and Freddie Mac. It does not use any proposed rental income, though, to help qualify you for the loan. Why? Because your primary intent is to vacation there first. Gift funds are allowed. So this one is, again, if you are just getting started out in this and you're needing help with your down payment, a great example is somebody maybe not wanting to go to college, or maybe just getting out of college, or saying, hey, instead of giving us funds for our marriage or giving us funds for our graduation or college, we would like to have a gift towards getting an investment property of a type, or vacation home loan. So this one does allow gift funds. You can have, if you're doing just 10% down, which is the minimum, you can have 5% of that gifted to you. If you are putting 20% down, for some reason they throw that rule out the window, and they say you can have the full amount of the down payment gifted to you. Keep in mind, a gift can be from a family member, spouse, or fiance. It can't be Bob across the street that you wave at when you're cutting your grass or he's checking his mail. Family member, spouse, or fiance. Not eligible on a 2 to 4 unit property. Only a single family residence. Okay, so a 2 to 4 unit property is a duplex or higher. You can then only do a primary residence on that, which is 5% down. They changed that rule, which is nice to just put 5% down if you're going to live in one unit. If it is a true 2 to 4 unit, I usually recommend you do a DSCR loan, as we went over last week, because that's only 20% down. Fannie Mae and Freddie Mac say if it's a duplex investment or higher, you have to put 25% down. So just keep that in mind. It's a 10% down up to a $2 million loan amount. Well, Brenda, my bank says they can only do it up to an 8065 loan amount, which is conforming, which we'll go through again. We are not a bank. We are a broker. We have many wholesale lenders that sell to the secondary market, which means we have many loan products for you. One of being 10% down up to a $2 million loan amount. Can only have one vacation home loan per household per area. So I get a lot of times, can I get one in this area and can my spouse get one in the same area? No, we hope you want a vacation together. If you don't, we don't want to know why. We aren't Jerry Springer. We're just trying to help you get generational wealth. So one vacation home loan per household. Now, if you wanted to get one and then your parents living in a totally different household wanted to get one in the same area, maybe all vacation at the same time to go together, but go to separate houses at the end of the day, that is totally normal and acceptable. Now, frequently asked questions on these vacation home loans. Can I close in an LLC? No. All conventional loans have to close in your personal name. We'll go over quit claiming on the investment slide. How long do I have to vacation there? So Fannie Mae does not have an actual number of days. People somehow came up with you have to stay there at least 15 days out of the year, or 14. Fannie Mae hasn't had an actual specific number of days for a long time. They just say for some portion of the year. Can I still claim depreciation and such on my tax returns for this? Yes. You actually have to file all rental income and claim that on your taxes. So if you do rent this out, you would still file on the Schedule E as an ECHO. Remember, we talked about this as well, Schedule E versus Schedule C. You would still file that on your Schedule E for the rental income, because you have to file all income according to the IRS, including illegal drug money, according to the IRS's website. Be careful, though. If you stay more than 14 days there, it could have tax implications on what amounts you can claim. Check with a CPA who specializes in this kind of thing. That might be where the confusion of 14 days comes from. For taxes, you might get penalized on what you can actually, the full amount that you can claim for that depreciation or things like that. Check with your CPA. Does this count against my debt to income ratio? Yes. All conventional loans in your name will count against your debt to income ratio. Well, why did the bank tell me I couldn't rent it out at all? Because banks, again, have rules on top of what Fannie Mae and Freddie Mac allow, and that is their own rule. That is not Fannie Mae and Freddie Mac's rule. That's just like saying, people are saying you can't wear white after Labor Day. Well, if I want to wear white, I'm going to wear white because that's your opinion and not the actual rule, apparently. How is this different than a second primary residence? A second primary residence is for you to live in around half of the year at least and not really rent it out at all. Many get confused on this. Most people get a second primary residence when they are house hacking, which means they've already gotten a primary residence. They've lived there for a year. They move out. They rent it out. And now they get a new primary residence with a lower down payment option as well. That's completely allowable as well, but that's different than a vacation home loan. Vacation home loan is not intended to be your primary residence. Can I have one and can my spouse have one in the same area? No, again, not for the vacation home loan. We will go over investment properties in the next slides. What if I bought one 5 years ago, but I just want to rent that one out and get a new vacation home in that same area? This is where I don't want y'all to get gray in guidelines. And you say that, but you really are like, I just want to do it for the 10% down. And I, intend on renting it out 100% of the time. Because if you truly don't want to use your current as a vacation home and primarily intend on using the new one as your vacation home, then you can do this. But make sure your intent is correct. Mortgage fraud is a real thing. And if they catch you 100% renting it out and not vacationing there, you will get charged with mortgage fraud and can do jail time. Not lying. It's serious stuff, guys. So watch out for that. Make sure your intent is true. Always be upfront and honest with yourself first. Always be upfront and honest with me as your lender. Now, the 15% down investment home loan. The primary intent is to rent it out. Yes, you can stay there as well if you want. It's not like you get an investment loan and you can't visit there at all, okay? Requires a minimum of 15% down up to that 8065 loan amount. Where am I getting that 8065 loan amount? That is the 2025 conforming loan limit. Remember, that means it's just not a jumbo loan, okay? That is the loan amount, y'all, that the purchase price would be higher. Anything over that 8065 loan amount requires 20% down because that would be considered jumbo, right? Or maybe it's 15% down plus a couple extra thousand to get it to that 8065, whichever at least is out of pocket. Gift funds are not allowed on this loan type. Remember, we've talked about DSCR, though. I don't want y'all to get confused. This is a conventional loan that goes off of your personal debt to income ratio. DSCR loans don't go off of your personal debt to income ratio. DSCR loans do. Some of them do allow gift funds. This is conventional investment. This one does not allow gift funds. You can use proposed rental income to qualify, though. So if your debt to income is already high at 48%, and if you don't know what a high debt to income ratio is, it's usually 50% and under is how you can qualify. Anything over 50% conventional will not allow. So let's say your debt to income ratio is already at 48%. You've seen me run numbers before on proposed rental income. If you are offsetting your new proposed payment with proposed income, which means, let's say your new payment's $3,000 a month. Let's say your proposed rental income is $3,000 a month. You're offsetting that mortgage payment. So guess what your debt to income ratio is still? 48% on that loan. So this one will help out if your debt to income ratio is already too high to possibly qualify for a vacation home loan in that area. You still have to close in your personal name and not an LLC. I've got some really good questions in the chat, so I will answer those as soon as I'm done for y'all. So let's go through the frequently asked questions on this loan type. Which loan type has the better rate? They're actually generally around the same, but I've actually seen lately 15% down investment have a better rate than 10% down. Why? Most lenders know that you are going to rent out that vacation home loan when you are not occupying it. they are going to be able to easily sell your investment loan to the secondary market as opposed to the 10% down vacation home loan, because everybody and their mom knows that you are most likely going to rent that out. The general population will likely rent it out. It's less riskier for the investor to just show that it's an investment loan up front. And that's why you may see lower interest rates for an investment loan than you would with a 10% down second home loan. Can I close either of these in my trust? Yes, you can close conventional loans in your trust. It does have to be revocable. It cannot be an irrevocable trust. That's where you cannot close in. But a revocable trust, yes, all day long for conventional. Some DSCR loans will not allow you closing in a trust. They will allow you closing in an LLC. So just make sure you know which option is best for you. Can I transfer title to my LLC, which is known as quit claiming title to your LLC? Yes, if the lender allows for it. Always ask your lender if they do. Banks will generally tell you no in an email, just as a heads up. So you definitely want to ask them first. They think it's a type of straw buying, which means it's not actually for you. It's not the case. You're just transferring that title to what an extension of you, the LLC. It's not another borrower. It's nobody else's credit score they're going off of. It's nobody else's income. You're just protecting your personal name with adding that LLC to title. Does my spouse have to be on this loan with me? No. If you qualify by yourself, you do not have to have anyone else on the loan with you. They are able to be on title, though, of the property. You actually don't want both of you on it if one of you can qualify, because you don't want that debt hitting your spouse's credit as well if you can qualify by yourself. If you have not watched my video on good debt versus bad debt, you can go back in to the YouTube lives and watch that. This is exactly what I'm talking about. We prepare for the next 3 to 5 years for your purchases when you work with us. And this is one of the strategies I talk about to my clients. Let's keep your spouse off of it if we can qualify with your income alone, because that debt will both count against each of you if you go your separate ways and try to qualify for something together. Now, again, this is my contact information. If you want to contact me, if you have any questions, that first one's my email. Yes, that's .co, not .com. The second one is my Instagram handle. So Financing Short-Term Rentals. I have created the slogan and the Facebook page, Financing Short-Term Rentals. This Facebook Live is brought to you by Financing Short-Term Rentals. I'm making it my public duty to teach all of you and educate you the easiest way possible on how to get loans for investment properties to help you build generational wealth. So I go through a lot of that on my Instagram as well. Our Facebook page, the Financing Short-Term Rentals Facebook group, you literally just search Facebook or Financing Short-Term Rentals. There's a link as well if you want to go to that link and join our Facebook group. You ask any and all financing questions in there. I'll be the one to personally answer you in there. And I think we almost have 4,000 members in there, which is pretty cool for a financing group. You wouldn't think it, but yay. And then our YouTube channel, Financing Short-Term Rentals, you can find all of these replays live there. You can also find them on Facebook, but I do believe after 30 to 45 days or something like that, Facebook deletes the actual live videos. So that's why right now we're live streaming on both, so you can go back to our YouTube channel and watch that. And of course, our phone number. If you're ready to get pre-qualified right away, there's that 800-816-7982. I'll put some more links up for you as we go along, but I'm going to stop sharing my screen and start answering questions. So let me take a sip of water. Okay. Camp said, have one short-term rental currently, about to pull the trigger on number 2. I have 25% to put down. Was thinking conventional vacation loan. You can definitely do that. You can put more than 10% down if you want to intend to vacation there. Keep in mind, you can put less than that if you want down. Just run the numbers to see what would be best for you. If it's best for you to put all of that money into that down payment, or would you save a little bit of that for maybe furnishing that property, photos for that property if you're going to rent it out, investing it in other properties or stocks or high yield savings. Just keep that in mind when you're running your numbers. Can a first-time home buyer do a vacation home loan if they won't be living in it? Great question. I should have added this to our frequently asked questions. Yes, you do not have to own your primary residence to get a vacation home loan, because it's not. That's why I'm trying to get away from calling it a second home loan. It confuses people. You don't need to own a current property to get a vacation home loan. You can rent, you can live rent-free. You don't have to have a mortgage on a property. So yes, you can be a first-time home buyer and get a vacation home loan. Can we say our primary intent is to vacation there, live our 2 weeks there and rent it out the rest of the time, no problem? Yes, you can say that if that is actually your primary intent. So you want to actually vacation there throughout the year and visit there. If you say you're probably not going to be able to even go there, then you know that that's a true investment property, and you need to make sure you are honest with yourself as well as your lender to make sure you're following the rules. But if this is your first investment property, I would recommend to look into this option, just getting your feet wet. You might realize you hate short-term rentals and renting out your properties. But you also, to become a good host, Andrew, you have to know the area you're investing in. Some people, as they get a large portfolio, they'll just invest based on cash flow. But when you're first getting started, you need to know the area you're investing in, and you need to be familiar with it for your guest's sake, but also your sake, so you know what you're getting yourself into. Hopefully that answers your questions. Can the loan and property be in an LLC? So no, I answered that. Conventional cannot be in an LLC. It will be in your personal name. So you must qualify for a 10% down vacation home loan with your own income and DTI. Zero rental income included, correct? Correct. So a lot of people can qualify that way based on their W-2, because a lot of times a vacation home loan is their first property they're getting, and they're able to qualify. Some people cannot, and that's why we do the 15% down investment home loan, because at that point we can use proposed rental income to offset that mortgage payment for them, where your debt to income ratio would essentially be what it currently is without a new property's mortgage on considered into that. Does the home have to be a certain distance away from your primary residence? Great question. I should have added that one as well. You are going to get 30 different answers on this. You're going to get 45 miles. You're going to get 75 miles. You're going to get 150 miles. None of that really matters. I usually say 45 miles is a general rule of thumb, but I'm going to give you two examples. Both go each way. I'm going to give you the Smoky Mountains for the example, my backyard. So that is Sevier County. Sevier County houses Gatlinburg, Pigeon Forge, Sevierville, and a place called Seymour. Sevierville, Gatlinburg, Pigeon Forge are the great restaurants, moonshine you can buy, bluegrass bands, Dollywood, water parks, all the fun things. Seymour is not. No offense to anybody living in Seymour, but that's just not the way it is. They've got a couple restaurants. They're a subpar. They're okay. They're not anything to write home about. And it's completely different than Sevierville and Pigeon Forge and Gatlinburg. So if you live in Seymour, you could essentially have a vacation home loan, which is in the same county. It's less than 45 miles away in Gatlinburg, because it's totally different. You've got the cabin, you've got the mountainous views, you've got the moonshine. We do have the backwoods moonshine in Seymour that we just don't talk about, but it's not the kind that you can buy on the streets. So keep that in mind. Now the other opposite end of the spectrum, okay? Let's give Panama City Beach and Destin, Florida, as an example. Those are 45 miles apart, right? But they are the same crystal clear blue water, restaurants. Most of the restaurants are the same with the chains. It's going to be hard to explain to the underwriter why you want a vacation home loan if you live somewhere exactly like it, even if it's 45 miles apart. I'm not saying it can't be done. I'm saying you have to have a good reason for it, and if that's truly going to be your vacation home. So just keep that in mind. With either loan type, can the property itself be put in an LLC while the loan is in my personal name? So again, that's called quit claiming. You have to get permission, or I wouldn't say permission, you just have to ask the lender that your current loan is with if they will allow that. Most banks will say no because they just think it's putting it in somebody else's name, which is not. An LLC is an extension of you, just trying to protect your personal name. Most lenders will allow it, but watch out for banks. You just want to ask them about that. With 15% down, can I qualify with only the rental income and not my own income? I'd love to have more cash to fix up the property for rentals, and the DSCR with 20% down obviously would take more down. No, you actually have to have income, whether it's rental income or W-2 income, unless you literally have no debt, which means you would have no credit, which would be a manual underwrite. And I'd have to look up the guidelines for a manual underwrite. I don't even know if they do manual underwrites conventionally for investment properties. I don't think they do. You have to have some source of income besides proposed rental income. That would be a DSCR only. DSCR does have 15% down options. Your interest rate's just going to be high in the low 8% range with top tier credit of 760 or higher. So there are options out there to just use that proposed rental income. Go on our YouTube page, Chelsea, and look up the 10% down DSCR loan and watch that, as that includes renovation loan as well to fix up the property. So you want to watch that as well. But yes, generally you have to have some sort of income, qualifying income initially on a conventional loan outside of the proposed rental income on the property. If I want to start making offers this summer, how do I get pre-qualified for either the 15% down or DSCR? Great question. I usually say, I'd say probably 20 days before you're ready to make an offer, you want to get that pre-qualification letter started or apply to get it started. The reason why I say ready with quotation marks is because if you all have ever gone out and you have a car, right? Let's say you have I don't know what they are, Nissan something, and you actually want a Chevy truck, a Chevy Duramax, whatever. I don't know what the trucks are, but you want to go ahead and get one of those. Well, now when you go out, you didn't recognize them before at all, those types of trucks. But now that you go out, you see them all the time because it's in your mind. It's a psychological thing that happens because it's on your mind. So I say wait until you're about 20 days from being ready, because what's going to happen is you're like, okay, I'm going to get pre-qualified, start getting pre-qualified now. And in 20 days, I'm going to start looking at properties. You're going to be in bed scrolling at night at 11:30, and you're going to start looking at realtor.com, and you're going to start seeing properties, or you're going to go in our Facebook groups and you're going to see some properties that we put up there, and you're like, I want this one. And you want to offer on it now because all these offers are coming in on the same property and you want to be able to get yours in, but you haven't gotten pre-qualified yet. So you want to have 20 days at least so you're prepared. So you have that pre-qualification letter to give to your realtor to offer in on that property for you. Now, DSCR is property specific. So we can essentially go off of your assets and your credit score for it, but it is property specific to hit a certain debt service coverage ratio, which means what that property is proposed to make rental income wise gross per year. One property in Panama City is going to do totally different than a property in Pennsylvania than a property would do in Branson, Missouri. So it has to be kind of area specific at least for us to send you a pre-qualification letter. So if you ever email me and say, I want to get pre-qualified for a DSCR loan, I say, okay, what area you're looking in and what price range. Then from there, I can gauge how many bedrooms that's going to be in that area. 3 bed, 3 bath with a view. That's, okay. Let's say 450, 500 in Branson. We'll go there, look at that. look at those numbers. Even though you don't have an address yet, I know where you're purchasing. I could essentially give you a pre-qualification letter based on that. But if you have no area, it's hard. Nobody really can essentially give you a DSCR pre-qualification letter because we have nothing to go off of. So keep that in mind. If a parent is co-signing and lives within that 45 miles, but child lives out of state, can they still do a vacation home loan? So there's not that non-occupied co-borrower thing, right? You would essentially just be another borrower on the loan. It wouldn't be co-signing. You would be a borrower. The only time you're co-signing or being a non-occupied co-borrower is primary residences. So if you're looking at a vacation home and you're within that 45 miles, it just has to be different than where you currently live. If it's the same, like, so it looks like you're Scottsdale, it's going to be hard to explain to that. What I would suggest is if you have the 20% down, maybe just gift those funds to your child if they can qualify debt to income ratio wise. If they can't qualify debt to income ratio wise, you would just do a DSCR loan with that 20% down. $1 million house versus condo. I don't know what that question would be about, but if you're talking about down payment wise, there's a 10% down loan option up to a $2 million loan amount. Condos are generally deemed in our areas that we specialize in, which is the areas you will be purchasing investment properties in. They're generally deemed non-warrantable because there are more investment units than there are primary residence units. Non-warrantable condos can be deemed non-warrantable for other things, such as the HOA being in current litigation, a hurricane that hits and causes damage. It will be deemed non-warrantable until those damages are fixed, and other things. But mostly in our areas that we are looking into invest would be because there are more investment units. That's generally going to have to go DSCR. It wouldn't go conventional. Conventional will not allow non-warrantable condos. So just keep that in mind. Oh, you said it's in reference to the quote. So condo versus house. Yeah, I mean, if you have a good reason and you actually are going to vacation there as well, that's the thing. There's no real co-signer on a vacation home loan. It's two borrowers and they both intend to vacation there. The only time you do a co-signer or non-occupied co-borrower is on that primary residence. If you already have a short-term rental with a vacation home loan, does that income count towards your income on your DTI? Yes. You are allowed to file it on your Schedule E. We are allowed to use it. Keep in mind, if it shows 365 days that you rented that bad boy out and you didn't have any personal use days, they could essentially look at that and say, I thought this was a vacation home loan. Usually it will show your average, your days rented out per year, and then it'll show personal use days. You want to make sure your CPA puts in your personal use days for that property, okay? But yes, we are allowed to use that income off of your Schedule E as an echo to help you offset that mortgage payment. So if you are thinking about a condo in Panama City, for example, you can only do a DSCR loan. I'm not saying you can only do a DSCR loan. There's full doc loans, but they still require 20% down. There's some banks in the local areas that may allow a lower down payment percentage if it's a true non-warrantable. If it's not a non-warrantable condo, that changes everything and you can do conventional. If it's a true non-warrantable, your options become more limited. Some local banks may offer a lower down payment, but generally you'll see about 20% down on that condo. Benefits of doing a refi from DSCR to vacation home loan. Usually you won't do that. They would see it's a DSCR loan and they'd be like, well, this is a true investment loan. It can't be a vacation home loan. Now, if you switch it around, a vacation home loan to DSCR, quite a few of my clients, I think I have 3 clients doing that right now because they want to put the debt in an LLC only to take off of their personal debt so they can qualify now for more conventional loans. And that's a strategy that we do with our clients as well. So we can definitely do it the other way around. But DSCR to vacation home loan, most underwriters will be like, nah, it's the 100% investment property. That's what a DSCR loan is. We're not going to allow this to be a vacation home loan. How do you know if it's non-warrantable or not? You can send it to us and I can let you know. Again, more investment units than primary residence. If it's geared towards overnight rentals, and that's mostly all that's in there, it's going to be non-warrantable. Great questions. Anybody else have questions? Throw your comments in the chat. I'm going to put some banners up for you. Again, if you have any questions on this that you come up with after you watch this, you can email me at Brenna@mortgageshop.co, not .com. If you need to schedule a specific call to start getting pre-qualified, you can go to mortgageshopmlo.com. MLO just stands for Mortgage Loan Originator. And if you can't wait and you're so excited and you want to get it pre-qualified right now, you can call 800-816-7982. I'm going to act like that infomercial. Callers are waiting or standing by, whatever they say. And again, our Instagram is Financing Short-Term Rentals if you want to look us up. Of course, if you ever see somebody saying like, oh no, I got a second home loan and it's first time home buyer loan, you know, in these groups that just means they don't understand they don't understand the terminology and they are meaning another primary residence loan. I just want you guys to make sure you understand that so you're not wasting your time looking for this unicorn loan when you can know the actual facts of what qualifies and what doesn't. Yay, you're welcome. This is why I do it. Education is key, and I'm going to, like Pinky in the Brain, slowly take over the world and teach everybody everything they need to know about getting their first short-term rental and continuing to build that wealth. So if no one has any other questions, I'm going to go ahead and end it. And then if you have any other questions after this that come up, please feel free to reach out to me. And as always, thank y'all so much for joining. And I will talk to y'all soon. Bye.